We are live, and I'm officially announcing a critical trade alert scheduled for November 23rd. Worst case, we'll push it out one more week, but I'm becoming highly confident in the next big move for our portfolios next week. We're going to be taking profits from our long treasury position, which is the only thing up today, and roll it into a position with 10 times the profit potential. Now, if you're not a paid member, call Dean so you don't miss this trade alert at 505-322-7515. We've been racking in some profits in a very difficult market. The most recent closed trade was betting on the price of oil going up and benefiting a select group of large oil and gas companies that are partnered with the US government. They have a monopoly on this market. With the way this has been set up, 68% profit. That's twice we've made money on NRGU this year. We've made money on natural gas twice. We're back into natural gas. I think we'll be taking profits on that in probably March or April of next year. High risk portfolio is now up 22.5% total return this year, which is fantastic considering stocks, bonds, and cryptocurrencies have been clobbered. Our high risk portfolio last year did much better at a 233% return. Again, this year, just to be above 0% is amazing. In October, we closed a 14% return for high risk. We've given up some of that this month, but we're not changing positions. In fact, spoiler alert, we're going to be adding to the positions that had a slight pullback. Safe growth portfolio returned an outstanding 31% in October, and it's already up 5% this month. So it's just killing it with that emerging markets play, primarily just driving some massive gains into our safe growth strategy. Buy these 5 stocks now and sit back. Let's look at the current trade setup. Now realize next week we're going to be making an adjustment. I'm going to reveal what that adjustment is at the very end of today's video for paid members only. So if you're catching a trial, call Dean so you don't miss out. Right now, we are loaded up on treasuries when interest rates went parabolic to an absurdity that we knew would collapse US government and soar its deficits and interest payments to levels that are just not sustainable. We went big on a leveraged bet on the long end of the treasury curve. And what's happening right now is the yield curve is inverting in a very scary manner. This is likely going to force Mr. Powell to pivot in December, otherwise cause severe pain to the whole banking system. So anyways, right now we are long TMF, and it's grown to 36% of the high risk portfolio. And our members are all following a unit of investment. Right now, one unit costs $2,113, and each unit is comprised of 19 shares of UVXY, our crash insurance, which is right now 8% of the portfolio, 97 shares of the leveraged long end treasury product on the long end. So we're betting on that 20-year, 30-year interest rate falling. TMF, 97 shares representing 36.3% of the portfolio. We're long the Grayscale Trust. This has been a complete fiasco with FTX blowing up. Now it looks like it may take some other big players under, BlockFi, Genesis, Gemini, all at risk, which is why I'm waiting a week or two to double or likely double down on that position. So perhaps there's a hint at what our trade alert may look like. We got a tech play with FNGU. That's 10 gigantic monopolistic tech companies that have been just completely battered down this year. Insanely cheap prices when you look 3-5 years out. You get leverage with FNGU times 3, 4 shares. And then we're betting on the cost of natural gas to go back up around, I think it's going to peak back out in around March or April. So we're getting in at just really low prices on oil, assuming that the war is not going to end anytime soon. And it's definitely, even though there's all this rumor talking of wanting peace, I don't see it in the cards, unfortunately. As much as I'd love for that to end, because that's a main source of inflation. As you know, I'm a huge fan of being long cryptocurrencies. And as long as that war is in play, it's going to cause some problems on supply chains and energy costs. 12 shares of oil. Okay, so let's look at the highlights. And again, that's per unit. If you pay up and become a member in the membership area, you can punch in exactly how much money you want to invest. It'll auto calculate which shares to purchase. And when I do a trade alert, it's going to fix the ratios and automatically tell you how to adjust your portfolio. Okay, so in general, we're very bullish. I believe peak inflation is in. It's going to start falling. The Fed needs to realize this and pivot soon. Otherwise, they risk completely crashing the global economy. So we're expecting a pivot in December in terms of becoming less hawkish. We're not saying they're going to stop hiking rates and stop quantitative tightening. They're going to change the rate of change to slow down and de-accelerate the hawkishness, which is going to be very important for markets looking 6 months into the future. But to close out the year, we have massive stock buybacks and CTAs of approximately $15 billion a day, pushing these markets higher. So you really don't want to fight that unless something colossal is about to happen. Ed Yardeni put out something which I agree with. Markets tend to bottom regardless of a Fed pause, hike, or pivot when the 10-year yield peaks and blinks. Many times the Fed has kept hiking, but the 10-year has fallen and the S&P 500 bottoms and rallies. We believe the market bottom was 3577 and look for a retest at 4305. That's exactly what I'm expecting. And we're seeing the yield curve invert really, really aggressively right now. This is the PPI and the CPI. So we've had both of these falling. So we were a little early predicting the peak, to be fair, but now it's happening. And you don't want to be on the wrong side of this trade. Now, if the Fed is going to pivot and the government's going to keep running $1 trillion deficit and supply chains are going to continue to fix themselves, and we're not about to ramp up war with China, the most likely outcome is you're going to make a lot more money in tech stocks and cryptocurrencies versus bonds. Now, if they're going to overdo it, they're going to over tighten. We're going to have problems passing our budgets. We get Congress and the House having freezes in the government spending. We start ramping up problems with China. Then this could quickly become a massive return for bonds. So that's really where we're looking at in terms of the best places to invest money. In the very short term, we want to be long hedges against the war in Ukraine via either oil or natural gas. But the second that looks like that's wrapping up, we want to get out of the way because the price of that could drop significantly before we'd want to re-enter a commodity hedge. Just looking at the PPI, so it's producer price index. And so first we had basically food and energy drive inflation. And then as those prices work their way through the economy, it forced a few things. It forced businesses to raise prices and it forced them to increase wages. So now what we're experiencing is services and wage inflation. And the good news is the leading indicator of that, the producer price index, is falling on both of those two critical items. So that's what we're seeing in that. As far as inflation peaking out and falling off, this is just a note from Target. Target says the net income dropped 52% as inflation has brought consumer spending to a halt. Target also said that theft is up 50%. The company lost $400 million in stolen inventory. Americans are feeling the pain from inflation. We are in a recession, and that's important. You don't want to get aggressive in stocks at the end of the recession, more like the middle. Okay, here's where we're looking at risks on inflation currently: fuel oil, airline fare, natural gas, gasoline, electricity. All of these are obviously tied together. We're seeing the food inputs fall pretty rapidly, housing markets falling, and rent is falling aggressively, as well as used cars. So again, that war is going to keep those items sticky in the short term, but every other item on the inflation list is currently falling. The U.S. is saying we need to create peace. Zelensky's got his 10 demands at the G20 meeting, and Russia is sending missiles over their capital, knocking out half the energy infrastructure while they're mobilizing 300,000 people to fortify the parts of Ukraine that they have still hold on to. So I don't see an end to the war currently, and that's why we're long oil in both portfolios. Now, some of the reasons why inflation's dying, it's because they jacked up interest rates and made the cost of borrowing ridiculous. So now nobody wants to borrow money, and that's why the whole economy is slowing down. This chart just shows you the difference from 2 years ago. A 30-year mortgage at 2.8, you could get a house for $395,000. With this jumping to 7%, essentially the house has increased by about 30% to $518,000. So your result is a $25,000 increase in the down payment and a 114% increase in the monthly payment. So you went from $1,300 a month to $2,700 a month. This is an interesting chart looking at the cycles of crypto and all the big blowups we've had. You go back to 2012, Mt. Gox was hacked, massive crash, 96% decline. Boy, if you bought into that and didn't worry about your short-term drawdown and just sat back, you ended up making one of the best returns in history till 2015. And then we had another blow up with Bitfinex, an 86% crash. If you bought at any point during that crash, you worked out really well by 2019 in December or January when we got that next big collapse. And that was really due to interest rates rising and policy at the Federal Reserve and Treasury driving interest rates up. You got another crash. Of course, they pivoted again, and we got that latest run up. Now, this latest crash was originally sparked by inflation going way above what anyone had expected, and it took the U.S. bond market down 50% approximately, the largest crash in history, and it took everything down with it. I believe that crash is over, and so the macro force is going to be extremely bullish for crypto. We're dealing with liquidations due to FTX, which was a massive money laundering scheme for US politicians. Now they look like they are trying to retaliate at Binance, who took FTX down. And now it looks like the outcome from FTX blowup could end up causing pain to Gemini, Genesis, a handful of other smaller lending platforms. So any kind of centralized exchange, get out. The only safe place we see to put your money is with GBTC, ETHE, or if you are a member, you can let us take your money in a very aggressive crypto strategy called Rebel Dividends. And that's where we buy a whole basket of cryptocurrencies, store it on DeFi, out of the hands of any centralized authority, and we use leverage. So that is the chart, and I believe this is where you're going to make the most money possible in the next 3 years. This is the Bitcoin exchange balance. We've had the most Bitcoin leave exchanges in history, and for good reason. We've always told everyone, if it's not your key, it's not your Bitcoin. You want to keep those in your own private wallet, out of the exchange. Use the exchange to get the coins and then withdraw them out immediately. And again, the only exception to this is the Grayscale Trust. Now, it's going to underperform because it's not the real, it's a derivative of the asset, essentially. And so it not necessarily will have the true value. But in general, for a stock brokerage account, that's our favorite safe place to put your money and get that exposure. Unknown entity becomes the largest Bitcoin whale in existence, $2.4 billion in one address. This is looking at the federal funds rate against the 2-year, and we're getting close to that moment where the federal funds rate goes above the 2-year, and that's when they absolutely have to pause. So that 2-year still being a little stubborn. It has been trading flat this month for thank goodness. So in the last 1 month, the 2-year is down 3%. So that's a very good signal. It's at 4.3, which would signal the Fed really only has to do another 25 to 50 basis points, and they're going to exceed the 2-year Treasury. And likely that'll be peak interest rates and time for a party. Main reason why we thought inflation would fall, interest rates rising, crashing everything, has just wiped out money supply and net wealth. And this makes people spend less money. So this is looking at the M2 versus CPI, and again, 9-month advance. And so what we're looking at is the CPI falling very hard over the next 9 months. The Fed must understand this and pivot, otherwise they risk sending the economy into complete destruction. So if that's what they're going to do, we're going to be all in on treasuries and the VIX. If we get that pivot I'm expecting, then we're going to make a lot more money in crypto and tech. A key factor for the Fed will be to see the labor market weakening. And so for this to happen, what we're looking at in this chart is the 10-year versus 1-year note spread inverting has predicted layoffs. And so we got the tech industry doing some pretty heavy layoffs currently, but we need to see the rest of the economy cool off because that's what's driving that wage price spiral. Too many jobs, not enough workers. Just looking at the record monetary tightening. So you can see usually these central banks team up and one hikes while the other cuts. And so it keeps the whole system in balance because we overdid it globally with something like $20 trillion of money printing. They're all hiking at once. This is unlikely to remain the case. And I want you to look, every time you see a big spike in black, what happens directly after it? The red goes deep. So expect massive cutting and easing in the very near term. Okay, this is looking at CPI versus apartment market conditions, expecting essentially the shelter component of the CPI, which is about 32%, to fall rapidly. So just a lot of reasons to believe inflation has peaked. So here we are looking at the TLT. TMF is TLT times 3 essentially. And again, the RSI hit this record low. We went not all in, but very aggressively in. And now that's the position that's making us money currently that we're likely going to rotate some profits out of. Okay, this is looking at the S&P 500 based on the 2-year treasury yield, assuming the yield's going to stop rising, flatten out, and then crash. Valuations are fair and are about to become undervalued. So amazing how that works out. And essentially what this chart's looking at is when should you buy stocks into a recession? And if you look at the blue line, that's the S&P 500. And then you look at the economic data in yellow, blue, and red. Note the stock market has always bottomed way before the economy. And that's because it's trying to predict what's happening 6 months into the future. So assuming we've been in a recession and we're going to bottom out in about 6 months, then right now is a beautiful time to be going long. Stock buybacks are going to be very aggressive to close out the year. We don't want to fight that trend. This is going back to the 70s. Everybody wants to equate what we're living to the decade of inflation. I want you to note in the orange line, we've got the US CPI peaking out around 1975. And then you get the bottom of the stock market a little bit before the peak. So you can see about 6 months ahead of that, before the inflation had actually peaked, the US stock market actually bottomed out, did a little head fake, and then resumed a massive return, almost doubling in 2 years. So assuming we're correct and have peaked out in inflation, now is the time to get greedy. This is the history of central banks' interest rates. They're going to have to drive interest rates towards zero again to keep this debt bubble growing. It's either that or the US government stops running a deficit and starts running a surplus. And with the way these politicians win votes, giving away money, there's no chance in hell they're going to do it. They're too corrupt. It's not going to happen. So as long as governments run deficits, we want to be long stocks, especially tech stocks and cryptocurrencies. Okay, so again, call Dean to upgrade at 505-322-7515. All right, let's go through cryptocurrencies. So this has been a bloodbath. I'm waiting till next week to pull the trigger to add to ETHE, most likely. Worst case, we'll wait another week or two. What's unclear is exactly how much fallout we're going to have from FTX, which is now spreading into, again, Crypto.com, Gemini, Genesis, BlockFi, all seem to have a lot of exposure, and they're going to, in turn, have other parties exposed. All in all, considering the size of this collapse, I'm very, very impressed with how well Ethereum and Bitcoin have held up. So here's Ethereum down 61% year to date. Again, this is exactly coincided with the bond market crashing. As long as the bond market's done crashing, and again, it's up today, it's the only thing up today, highly likely that Ethereum is bottoming out and getting ready for its next 2 to 3 year cycle to the upside. Now, even if you had bought and held through every crash and just never looked at it from 2016 to current, you're up 89,000% with Ethereum. The Grayscale Trust is underperforming Ethereum, down 72%. And again, the main idea is there's a limited supply of Bitcoin and Ethereum, and it's decentralized. It can't be manipulated by central authorities. The US dollar will be printed to infinity as long as the government continues to operate as it is. Just looking at the history of debt since the 70s, and you can see it very, very, very rare times where we try to reduce debt, never works. And the reaction typically is a massive buildup of debt directly after that. Here's the plans for the US federal budget's deficit. Of course, they'll probably orchestrate some crises so they can spend more than this, like we saw in 2020 and 2021, where they ran $2 to $3 trillion deficits. But for something less deadly than the freaking flu. But now their plan is to ramp up deficit spending from $1 trillion to $2.3 trillion in the next decade. So as long as they stay on that track, we're perfectly fine with our investment thesis. Here's what's most important. Let's look at the bond market relative to cryptocurrencies to get excited about buying the dip, which most people hate doing. Most people like to buy into rallies, but of course you make a lot more money buying into the pain. With the TLT currently down 40%, it's up a little more since I wrote this slide, from the 2020 high. The potential for a sharp reversal is gaining momentum as inflation tops out and is likely to start falling rapidly by mid-2023. There's a chart of the TLT, which represents long-end bonds rising in interest rates, which has crashed everything this year. The most recent 14% gain in the TLT from April 2020 through December 2021 led to extreme returns in cryptocurrencies. So you got a 14% bounce in the TLT, but you ended up with 114% double in Ethereum. And it was wild and violent and up and down. But as long as you knew the bond market was recovering and held on to the position, you made a ton of money. And that's exactly what we're going to do right now, because that's exactly what's happening in the bond market. Matic gained 525%. So if you think of Ethereum as Windows, think of Matic as an application. So it could be like Microsoft Word or Microsoft Excel. If you're thinking about your phone, Ethereum would be the same thing as the iOS operating system, and Polygon could be thought of something like perhaps Snapchat or Twitter or some app on your phone. Now, Polygon is a second layer solution to make Ethereum faster. It really runs behind the scenes, so it's not an app you'd actually look at. It's probably the most important technology being developed behind Ethereum. We believe you can make probably 5 to 10 times as much money in Polygon versus Ethereum. You can't get Polygon in your stock brokerage account. You have to know how to go buy these assets directly from the exchanges. Now, if you want to switch out your Ethereum position to Rebel Dividends, and you have to be a paid member to do that, we buy the Polygon for you with leverage so you can outperform. And there's the same chart delivering 4 times the return over that same period. Now, there's other apps being designed on Ethereum that we're a fan of that do different unique things to help grow the ecosystem. One is Link. This went up 400%. Again, it's another Ethereum app. Aave, this is where we actually get leverage and borrow money for Rebel Dividends, went up 900% over that same period. Curve, 310%. Curve has been phenomenally useful during all these different wars between different stable coins and different exchanges. People are using Curve to short each other, and it's had incredible growth during a period where everyone else was losing users and usage. So the setup for the TLT is phenomenal. We're going to go up way more than 14%. Likely we're going to try to test those recent highs in the last lockdown, where the whole world went to lockdown. Not sure we'll get that high, but somewhere around that. So we could be seeing 2 to 3 times the move easily in the TLT. It'll probably top out around 2025. This is just looking at average cycles, no guarantee, because you never know what these politicians and warmongers are going to do to orchestrate different crises. But essentially, we believe we're going to look at a run up to around 200,000 in Bitcoin that ends in 2025. Massive money to be made. Commodities, buy 12 shares of BOIL, your inflation war hedge. Very simple strategy. We've actually pulled this off twice. We're going for a third time. Wait for Germany to fill up its tanks and drive the short-term price of natural gas low. And then as they start to draw it down, sell it for a profit. Brilliant, right? So that's exactly what we expect to happen. And I think we'll be taking profits around April. And again, it's all of Europe that is filled to the top. Electricity costs have been falling again, but as those natural gas reserves fall and everything gets cold, then expect these to go right back up. We would like to get back into NRGU, but there's more money to be made very quickly in BOIL than NRGU. So we're waiting for a big pullback. Goldman Sachs predicting $100 oil for the rest of the year. If they start really picking on Russia, 2 million barrels go offline, oil could rocket up to 300. So they're talking about price caps on Russian oil. Again, if they did that, Russia would just take the oil off the market and crash the global economy. So I'm not so sure that will happen. So we're just on the sideline to go back into NRGU. Okay, so before the election, we had $35 oil. War starts, we're at 75. Now we're at 91. So you just need to realize if the war ends and supply chains are fixed and we start increasing production in the US, there's huge risk being long NRGU. And that's why we're long BOIL. Now, a reason why the price of oil is going to be sticky is we've drained the strategic petroleum reserve too low. They're going to have to stop doing this soon and start buying oil back. So sticky oil is going to most likely remain. Now, just how valuable can these oil and gas companies get? If we go back to 2007, it was 16% of the S&P 500. Today, it's at about 5 to 6%. So there's still a lot of upside. But we've got Exxon at record valuations currently, and we have the catalyst of oil falling for a number of reasons. One would be the Fed overdoing the hiking. That would crash the commodity market. And two would be some sort of peace deal in Europe. Or three, imagine the US actually takes advantage of its huge supplies of oil and increases supply. Right now, Mr. BIDEN is saying no more oil. So I'm not so sure that will happen anytime soon. Here's that BOIL chart. Again, we got in February, sold in June, got back in July, sold in August approximately, and we're back in today. So we've seen this jumping up and down, huge gains, huge losses every day. Just relax. All we care about is when Germany's reserve starts to fall. And once it starts to get low, that'll be peak. So I'd expect us to sell this in the $80 to $100 range one more time. Here's the chart on BOIL over the last 3 months. We were very patient to get into it. And unless the war is about to end, this is a huge opportunity to be long right now. You can see that extreme volatility over the last 5 days, bouncing between 35 and 40 every other day. Here's NRGU, which we sold near the top, not at the top. And again, we would like to get back in potentially in the $300 range, maybe lower depending on what happens. There's the price of oil. So again, you start doing price caps on Russia, NRGU is going to skyrocket way beyond 600 because it's going to drive the cost of oil probably towards 180 to 280 and crash everything else out there. So carefully monitoring this situation. All these sanctions that Europe has been putting on Russia so far have been easily circumvented, and that's why we don't see these outrageous oil. In general, we got the Greeks shipping the oil to India and China, and then they're reselling it back to Europe. So it's pretty funny plan they have there. Okay, there's Exxon just at extreme valuations. That's why we're out of NRGU. I don't care if it could go up much higher unless we see real reason to think that oil's going back above 130 due to sanctions. We're just going to be patient, wait for a huge sell-off. Okay, so that is the main update today. Call Dean to upgrade at 505-322-7515. Oh, excuse me, we do have a few more slides. Okay, UVXY, I do want to add to. Eventually, I'm not sure if we'll pull that trigger next week. We've gotten light, safe growth at 5%, high risk at 8. As you know, I like to keep that closer to 10 just as an insurance policy when we're using leveraged ETFs. And so this is looking at the moving average we're going to have to get out of. This is UVXY over the last month, down 25%. It's getting squished. So probably a good time to buy to add some exposure here in the near future. Now, the main reason why we have UVXY is for a black swan event that causes a massive panic and a sharp decline in a short period of time. And so back in the lockdown days, SPY went down 25% in a month, UVXY went up 1,000%. So if you had 10% of your portfolio long UVXY and the other 90% went to zero, you ended up even because you doubled your money on the 10%. So it just goes to show you how valuable this can be in those rare black swan events. This is the 2008 to current analog. Only reason I would see this playing out would be if either A, the Fed is an idiot and just keeps jacking interest rates up way too aggressively and crashes the economy on purpose. That'd be one. Two, we're wrong on the inflation. It keeps roaring higher, which again would lead to the Fed over tightening. Or three, some very bad policies with energy develop in Europe that spike oil well above 130. Otherwise, I don't think this is the most likely outcome. This is looking at crises that have developed when the dollar went too high. We do have the dollar selling off. We were long. That's another play we made good money on. And I think we got out near the top on that one. So we're out of dollar, expecting the dollar to fall aggressively for a couple of years. And this is what's going to really drive the price of tech stocks and cryptocurrencies up. This is just looking at times where the Fed overdid the hiking cycle. It doesn't look at all the times they've pivoted or saved the market. So it's a little bit biased in that respect. So we do need to realize if Mr. Powell doesn't pivot soon, they do risk dramatically over tightening and crashing markets here, more so than they already have. Okay, the Treasury position, again, this is a bet that inflation's falling. Here's the components of inflation. 32% is in shelter. Absolutely, that's coming down. Food's been falling. Energy's sticky. So really the only one that looks really sticky here are the services and the energy. Now we're seeing services start to fall. We haven't yet seen the entire labor market cool off. We're seeing it in tech because their stocks are down 50 to 80%, but we're not seeing it in the rest of the general economy. So we're going to really focus on our wages, job openings, energy are really where I see the risks here on the inflation side. But that's not a big chunk of the whole picture, as you can see. The bigger chunks are primarily falling currently. Now, Bank of America actually thinks we're going to have negative payrolls by early 2023, quarter one. This will give the Fed what they need to pivot. So far, no reason to see that that data has not come in yet, but it's been starting to slow down. Here's the change in household net worth versus CPI with a lead and by 4 quarters, so it's leading a year. So this is expecting the inflation to crash for a year unless assets go back up because they've wiped out, in this chart, $14 trillion of household net worth via the rate hikes so far. So TMF is down 37% in the last month, but it's, as you can see, it's been going up aggressively since we went very aggressive in our portfolio. Here's a TLT, which is a non-leveraged version of TMF. And you can see it can have these big crashes, but directly after the crashes, it rocket ships back up. So again, the TLT can go up for 2 reasons. It could be a healthy environment for stocks and crypto, or it could be a very unhealthy. And that all will be completely dependent on the Fed pivoting or not. So if we think the Powell's going to just keep hiking rates into oblivion, we prefer treasuries. If we think the Fed's going to slow down and pivot, we want to go super aggressive in tech and crypto. And I think it's going to be about a 2.5-year run up. Here's the TLT in the last 3 months. Here's LQD. So we're just looking at some other proxies of the bond market. So investment grade bonds are already front running this. You can see they have less drawdown than the US government bonds. And the junk bonds are front running it even further into the future, down less than US Treasuries. So the worst bonds in the world are recovering faster than the safe haven bonds. Okay, now we're looking at different spectrums of the US bond market. This is a 3-month. You can see this went way above a level anyone thought possible. The trend had been lower highs over time. So for this to hit 4 is just absolutely insanity. But here you go. Here's that 2-year. This is really what's going to control everything. We really want to see the 2-year top out and fall. And that's what we're starting to see currently. Here's the 10-year, way out of trend, likely going to crash back towards lows, if not new lows. And so you can see the US 10-year is already starting to fall. If we look at the 2-year, it's flattening. The 10-year is already falling. 30-year, same thing, and it's also starting to fall. Okay, some of the input costs, lumber futures down 27%. Year to date, lumber futures are down 64%. Copper futures starting to flatten out here. Baltic Dry Index fell from 6,000 to 1,300. So that's a 43% decline for year to date. Wheat futures down. CPI, as you can see, it can have these aggressive run-ups, but once it peaks out, it falls aggressively, and you get massive returns in bonds. And if the economy is healthy, stocks such as tech and crypto. Michigan sentiment is at extreme lows, typically very beautiful time to buy stocks. Initial claims starting to pick up. If this starts to get towards 260 to 300,000, that'll be a great sign that the Fed can stop its hiking. This is the 10 and 2-year spread going negative. This typically marks peak interest rates on the long end and very close to when the Fed will have to pivot. 10-year versus the federal funds rate. Okay, so they have now essentially push the short-term rates above the 10-year rates. Now think about how banks work. They borrow short-term and they lend long-term for a profit. If you have an inverted yield curve, you lose money trying to do that. That's why they have to fix this soon. We're not in the dollar right now, but here was the impact of killing the money supply, hiking rates, and selling mortgages and treasuries. We drove the dollar straight up and every other currency down. This is not sustainable. This is absolutely not sustainable and is likely to reverse rapidly. We believe that is about to occur right now. Here's DXY. This is mainly against the euro and the yen. I want you to note, as the US debt bubble gets bigger and bigger, when there's a crisis, the peak value of the dollar has become lower and lower. So it's still the reserve currency. It still gets all the attention when we have some sort of crisis, but the peak value is getting lower and lower over time. Furthermore, when we're in an easing period, the low end of the DXY is going lower and lower over time. So if we send DXY to a new low in the 70s, you could potentially be looking at $1 million Bitcoin. No joke. Now, these moves are taking decades to play out on the downside. I'm looking at a short-term cycle of about 2.5 years for us to see DXY fall towards 90, I think will be where it bottoms out, and we want to take some massive gains. Here's the euro losing 20% of its value against the dollar. Here's the Japanese yen losing 20% of its value against the dollar. The Chinese yuan losing 11% of its value against the dollar. The only currency going up against the dollar is the Russian ruble, because they have the most commodities of any country in the world. So their currency is doing just fine. Okay, tech stocks we're very bullish on. FNGU gives you a leverage play. If the S&P 500 is down 25% and you buy it, here's your returns 1, 3, 5, 10 years out. 21%, 37%, 83%, or 213%. So don't worry if you're getting the perfect bottom. This is a great time to buy. Here's a chart of FNGU going from 400 down to 54. This is the unleveraged picture. They did a stock split, so now it's trading at a different price. Oh, they undid their stock split, excuse me. So it's back to this price. I'll have to go update that. Here's the S&P 500 down 14%. The NASDAQ down 24%. Emerging markets down 21%. So again, this is just pointing out the pain the markets have seen from bonds this year. This chart's looking at the performance of the S&P 500 versus emerging markets. I want you to note every other cycle, emerging markets is greatly outperforming. In our safe growth strategy and with F&G, we have exposure to emerging markets. We think that's where we're going to make the most money in the next cycle in terms of big stock markets. Now, if Europe's about to collapse, we want to be ahead of that and get out of stocks in general due to contagion risks. But it's not doing that bad, surprisingly. EFA is down 17%, the European index. So it's not, in fact, it's outperforming some of its peers, which is mind-boggling. We're not in uranium right now. We'll probably get back at some point. It's down 13% in the year. Rare earth metals down 14%. We're out of that play currently, likely come back. Some of the leaders in tech, Amazon down 40% this year, Apple down 13.5%, Alibaba down 40% after losing 50% last year. So there's a lot of pain out there, a lot of deals. Okay, so the consumer spending hit a new record. It's just hard to stop that US consumer from borrowing and spending. US balance of trade still healthy at negative $70 million. Retail sales grew 0.4 in the last month. Consumer credit grew $24.98 billion. US banks grew their balance sheet by about $100 billion. So everything is just trucking along fine and dandy. China's PMI is below 50, but they keep locking down the whole country. China's exports, despite all this, still healthy in the 300 billion range. Chinese imports are down considerably at 213 billion. But when you realize they've locked the whole country down to fight inflation, then that makes sense, and that's not that bad. Okay, so that's our presentation today, and where we're looking at the markets. We're about to get cut off. If you're not a paid member, I'm going to log into the membership area, look at the exact positions in both portfolios, the track record, and talk about what we're expecting next week. So call Dean to upgrade at 505-322-7515.